Hi, this is Austin Hill. I am Ryan's older brother, and I wanted to introduce you to Pat. Pat is our property assessment tool, and Pat truly gives us a competitive advantage when we're analyzing real estate deals. Ryan comes from a finance background. I myself come from an engineering background. We have built Pat from scratch to make sure that we have truly the best tools to analyze these multifamily properties and get the best returns to our investors. So we wanted to take some time and just walk you through Pat. We look at really these real estate deals as a puzzle. There's so many different pieces, and if they are organized in the correct way, there can be extremely great results. So I'm going to walk you through really the three different phases that Pat gives us a competitive advantage. One, during the analysis phase. When we come in and analyze a deal, we get sent all kinds of deals. We're networking with brokers, talking directly with sellers. We're doing a lot in our markets to make sure that we see every deal that comes available. So we got to get in and out quickly so we can focus our time where it's needed. These gray cells here are where we need to enter data. And by just entering the data in these gray cells, we can quickly see, yes, this is a deal we want to spend more time on, or no, this does not fit our investment criteria. And that's a huge advantage because we're able to quickly hop in, hop out. Now, second phase where Pat is truly helpful is in the negotiation phase. In addition to our numbers-based background, Ryan and I also have a pretty good sales background, very experienced. I've had about 8 years in corporate sales. Ryan's been doing about 6 years in high-level sales as well. So both of us have experience. And from our experiences, we've seen tremendous results having negotiations from a numbers-based, factual-driven conversation. And this is what Pat really allows us to do. When we're negotiating with sellers, we can look at all these numbers and we can have a story behind why these specific terms are very important to us. And we've seen that really be successful over the courses of our negotiation. So a few different just spots I'll share with you. Right here, 27% down is what we're going to be bringing on this deal. You don't see that very much. It's a very odd number. But on this specific deal and how these numbers are all shaken out, that is the sweet spot where it's optimized for the best returns for our investors. So it gives us a story when we're sharing with our investors or the sellers why we're going at 27% down. There's a very specific reason, and I could walk you through all the numbers, but I'm not gonna. I'm just gonna leave it at this. And really, I'm going to leave it there as far as the negotiation phase, but really having those factual, numbers-based negotiations has helped us out a lot. The third phase that it really helps us out is post-close. We've had our negotiation, and then we've been able to close on this deal. These numbers here are the current income and expenses. These numbers here are what we look to get to. So looking at this side on the left here, the current average rent is $727 per month. That is far below market average, which is $809. In addition, they have no ratio utility billing system. That is standard in this market. So $50 per month per tenant is what they're not getting right now. This is a value add property, and it really is what allows our investors to have a great IRR as well as current cash flow. So $73,000 a month is what we're going to be able to add through the RUB system. And then we're also going to be increasing the rent by about $80 a month. You need to gradually introduce that. So we have built that into our spreadsheet. Again, our goal is to model our deal and how we're going to be managing and negotiating as best as possible. So going to the management phase, we're saying we want the rents to be $809. We want the RUBs to be installed, but it's going to take 24 months to get there, and it's going to be at an 8% clip is what we're going to need to be increasing the rents at to get to that 809 figure. To account for that, we have different things. Vacancy is at 10%. That's not normal, but because we're increasing rent and adding a RUB system, it's going to be more vacancy. It's just the nature of the beast. And we have property management, boots on the ground who have those conversations. They're the professionals. We set the goals and what the metrics need to do, but we aren't the ones having the conversations. We let the pros be the pros. They do this day in, day out. We leave it to them. It's just very important to have a metrics-driven conversation with our property management and something that we can truly have deliverables on. And lastly, I'll bring you to the investor breakdown page. This is where we have the share this with our investors. We can certainly take a peek behind the curtains if they want, but often folks don't want to see all those numbers. So this is where we look and see, okay, we've talked with the brokers locally on a established property that we're going to be at the point where we have RUBS, we have market rent. 5.7 is the cap rate, typically where we see a sale at. So we're able to run those numbers. It says at month 48, going back to our cash flow, we can look and see at month 48, dating back these previous 12 months, what's our net operating income? And then we're able to have that number at this specific cap rate we sell at, what is the value? And that's added into our IRR final conversation and calculation with our investors. So it's just a numbers-driven, factual conversation throughout the entire time, both with our investors, while we're negotiating, while we're managing the property. Pat, our property assessment tool, truly helps us out in all three of those phases.